Hello everyone, Elliot Gu here with the Free Market Speculator, Smart Bonds, and the Energy Bulletin. Welcome to my Sunday Deep Dive. In this weekly video, we look at a key chart, trend, or indicator that caught my eye over the past week, and I explain what it means, or at least what I think it means for markets. This year, I've received a ton of questions around two related investment themes that have been in the news. And they've often been receiving media attention for all the wrong reasons. I'm talking about what's known as private credit and a group of high-yield, publicly traded stocks known as business development companies, or BDCs. Now, these BDCs offer yields anywhere from around 7% up to 12% plus. Here are just three of the scarier headlines I've seen over the past 18 months about private credit specifically. First up, IMF warns opaque $2 trillion private credit market poses vulnerabilities to the financial system. Financial Times, that was back in April of 2024. Here's another one. The credit market is humming, and that has Wall Street on edge. That's the Wall Street Journal, September 29th, 2025, just last year. Another one, cracks in private credit deepen as wave of hidden defaults looms. Bloomberg, that was March of this year. Let me be clear. There are risks to understand here, but I believe the panic the mainstream media has been whipping up in this market has created some opportunities for investors, particularly those seeking high yields. In fact, just last week, I added some exposure to the BDCs in the model portfolio in my Smart Bonds service. So I'd like to back up here and explain what private credit is, demystify it if I can, why it is growing, and what's behind the recent panic about private credit and the related business development companies, or BDCs. First up, what is private credit and how large is the market? Well, depending upon exactly how you define the term, private credit, estimates are that the global market is anywhere from $2 trillion up to $3.5 trillion in size. However, the largest slice of the private credit market is really just direct lending. Essentially, these are loans made generally to smaller, so-called middle market companies by non-bank entities. In the US, the term middle market can refer to companies with anywhere from 10 million to over $1 billion in annual revenue, though the core sweet spot of private credit is companies with between about 100 million and 500 million in annual revenues, sales. These are typically companies that are not publicly traded, they're not listed on the stock exchange, NYSE or NASDAQ, and they do not have credit ratings from the major ratings agencies like Standard & Poor's, S&P, Moody's, and Fitch. This direct lending slice of the private credit market alone, that's the largest section of it, is estimated at roughly $2 to $2.5 trillion in size. So let's put that into perspective historically. Now, 20 years ago, back in 2006, direct lending by non-banks was an afterthought, estimated in that $15 to $20 billion annualized range. And even a decade ago, this market was less than $200 billion in size compared to $2+ trillion with a T today. Now at this point, you might be asking, why did this market explode in size over the past decade? And why aren't traditional banks making these loans? The simple answer is that new banking regulations put in place after the Great Recession and financial crisis of 2007 to 2009. And I'm talking about regulations like the so-called Dodd-Frank Act, which was passed in 2010. Well, they forced traditional banks out of the corporate lending business. Prior to the crisis years, companies too small to raise capital by issuing bonds, like high yield or junk bonds, could borrow money from a bank, perhaps a big national name like JP Chase or Bank of America, or these companies could borrow from super regional or smaller regional or community banks. However, after the crisis, the US government, along with most governments around the world, major governments around the world, made this traditional core banking function less attractive. The best way to illustrate how this works and how changing regulations have squeezed banks out of lending, particularly to small and mid-sized businesses, the best way to illustrate is with an example. Now I'll use KeyCorp, which is a regional bank behind KeyBank, headquartered in Ohio, that trades on the New York Stock Exchange under the symbol KEY, K-E-Y. Banking regulations essentially set a minimum level of capital a bank needs to have to support their assets, right? So there are three primary asset types that a regional bank would hold on their balance sheet. First up, number one, is loans. That's pretty self-explanatory. Number two is securities, and typically that's a portfolio of assets like US government bonds, mortgage-backed securities that are backed up by agencies like Fannie Mae, or municipal government bonds, local, state, local government bonds. And the third thing is reserves. Now these are held at the central bank. So in Key's case, like all US commercial banks, that would be the Federal Reserve here, the Fed. Now regulators give different types of asset a risk weight, okay? Some assets like treasuries and central bank reserves, well, they have a risk weight of 0%, meaning the bank can hold these assets without impacting their regulatory capital ratios. Meanwhile, agency-backed, mortgage-backed securities, well, they might have a risk weight of 20%. You know, a standard residential mortgage might be a 50% risk weight. And corporate loans to middle market companies, well, they have a risk weight of around 100% or potentially even much higher than that, depending upon the companies that are being lent to and how the loan is structured. So it could be 150% or even more. The bank's capital ratio is equal to the bank's capital, total amount of capital in billions of dollars, divided by total risk-weighted assets. Now the issue that is between 2006, which is the year before the financial crisis kicked off, right? Between then and today, banking regulators in the US and elsewhere, like Europe, right, have changed the definition of capital used to calculate these regulatory capital ratios. They've also increased the minimum capital ratio a bank must maintain to be considered well capitalized. So back to KeyCorp specifically, and I've pulled these numbers from their 10K report filed with the SEC back in the year 2006, right, 20 years ago. A lot of this actually comes from Exhibit 13, if you want to look it up. So as you can see here on this slide, back in 2006, Key had about $92.3 billion in assets on its own balance sheet, with almost 3/4 of that, some $67.5 billion, consisting of loans to businesses and consumers. Now, more specifically, around 73%, so almost 3/4 of that $92+ billion in loans, that loan book, well, it was actually commercial loans, mainly business loans, and including loans to middle market companies, also commercial real estate and the like. Securities, like Treasury bond holdings, well, they were a little over 13 billion of Key's assets back in 2006, or about 14% of overall assets, while cash and central bank reserves were just over $3 billion, or around 3.4% of total assets. The rest was the value of their premises and things like goodwill. Goodwill is just an accounting term that relates to Key's acquisitions of other banks over the years. Now, back in 2006, US banks were still operating under the so-called Basel I structure, right? And the Key regulatory capital ratio was known as Tier 1 capital. Now, here's how that looked for Key back in 2006 and what it would mean today under modern regulatory standards. Now, I know this slide is a little busy, so allow me to break it down piece by piece. First up, look at the middle section of this table titled Risk-Weighted Assets Breakdown. As I said, Key had a little over $92 billion in assets on its balance sheet, mainly loans, back in 2006. Once we risk-weighted those assets under those rules, 2006 rules, the company's risk-weighted assets on the balance sheet came to 77.49 billion US dollars. That's because, of course, as I said, some of those assets on the balance sheet, like Treasury bonds or reserves held at the central bank at the Fed, they have a 0% risk weight. They don't count, if you will. And some, like conventional mortgages, they might have a 50%. They might have had a 50% risk weight. Now you'll also note that Key had some $25 billion almost in off-balance sheet risk-weighted assets. Now, off-balance sheet sounds a little dodgy, I know. But the reality is most of that represents lines of credit extended to businesses that were not fully drawn, or home equity lines of credit, HELOC loans to consumers that were not fully drawn. For example, let's say that a business has a line of credit with Key for $10 million that they can draw upon, but they only have drawn $2 million of that $10 million credit line. That undrawn portion, $8 million in this example, still needs to be accounted for on a risk-weighted basis in that regulatory capital ratio. So, some intangible assets like goodwill, they were also deducted under those 2006 rules, as today. Bottom line is that all in, Key's risk-weighted assets were a little over $101 billion in 2006, on and off balance sheet, risk-weighted. Now here's where it gets really interesting. Look at the top part of my table. Under those rules, the 2006 rules, Key reported $8.338 billion in so-called Tier 1 capital. That's for 2006. That means that their Tier 1 capital ratio, the most important regulatory ratio in the banking industry back in 2006, was 8.24%, reported back in their 2006 10K released in early 2007. Now that's just that capital of $8.338 billion that I just told you, divided by the $101.135 billion in risk-weighted assets that we calculated in this slide. Back in 2006, the statutory minimum Tier 1 capital ratio was 4%. Now, if you fell under that, you faced immediate intervention from regulators. Bad, right? Now, a Tier 1 capital ratio of 6%, that was known as the well-capitalized threshold. So that was actually considered good, anything over 6%. Now, the peer average in 2006 for a regional bank like Key was more like 7.5% to 8%. Most banks don't want to cut it right on the edge of what's allowed from a regulatory standpoint. So Key, with a Tier 1 capital ratio of 8.24%, was considered in a very strong capital position from a capital position back in 2006. However, back in 2006, banks like Key were allowed to include so-called trust preferred securities in their Tier 1 capital base. Now, these are hybrid debt and equity, stock and debt securities. And back in 2006, that accounted for almost $1.8 billion worth of Key's reported $8.338 billion in Tier 1 capital. Now, that was banned under that Dodd-Frank Act passed in 2010. The term that we use today, Common Equity Tier 1, or CET1, well, that didn't exist in 2006. But today, that is the key capital adequacy ratio for banks, not just Tier 1 capital. We can estimate what Key's CET1 ratio would have been back in 2006, what the bank would look like to a modern regulator, if you will, by subtracting those trust-preferred securities from their 2006 Tier 1 capital. That would be the biggest adjustment. And as you can see in my table here, now Key's CET1 ratio on a pro forma basis back in 2006 would have been around 6.5%, a little under 6.5%. And that would not be considered well capitalized today. The regulatory minimum for CET1 today would be 4.5% for regional banks, plus what's known as a stress capital buffer. Now that's something that's specific to each bank, based on those annual Fed stress tests that you may have heard about. Now that stress test capital buffer, the SCB, it has a floor at 2.5%. So the absolute minimum, right, for a regional bank would be 4.5% plus 2.5%, or a overall CET1 ratio of 7%. And that's assuming a stress capital buffer set at that minimum of 2.5%, which really doesn't happen in the wild, so to speak, right? The minimum CET1 ratio hurdle for a typical regional bank, the statutory minimum plus the actual stress capital buffer set for that institution by the Fed would be more like 7.5% to 9%. And Key and its peers typically have CET1 ratios closer to 11% or 12%. Again, they don't want to operate at the minimum. They want to operate comfortably above that. So let's look at Key's actual position in 2025 last year based on their annual report, their 10K for last year. So last year, under modern rules, Key reported a CET1 ratio of 11.78%. Now, as I said, statutory minimum is 4.5%, and on top of that, Key needed to maintain an extra 3.2% stress capital buffer, so a little above the minimum of 2.5%. And that was based on the Fed's annual bank stress tests. Now, combined, that comes to a 7.7% regulatory minimum. Below 7.7% for Key, the bank would face restrictions, such as not being allowed to return capital to shareholders as dividends or share buybacks, or pay discretionary bonuses to Key employees. Obviously, they don't want that. So Key had a nice excess capital cushion last year of 4.08% with its 11.78% CET1 ratio. That was a capital cushion over that minimum required for that bank specifically of 7.7%. However, what's important here is, do you see how Key is required by bank regulators to hold more capital on its balance sheet to support loans? And also the definition of capital today is far more strict than it was in 2006. Think of it in this way. Let's say a bank wishes to make $100 million in loans to a group of 10 small and mid-sized companies that do not have credit ratings from a major ratings agency like Standard & Poor's or Fitch, and they're not publicly traded on the stock exchange. To calculate the amount of capital the bank needs to support those loans, that loan book, we'd look at this basic formula. Required capital equals the loan amount, in this case 100 million, times the risk weight, right, times the target capital ratio. Now back in 2006, most such commercial loans had a risk weight of 100%. And let's say the bank was targeting an 8% capital ratio, a full 2% above the well-capitalized threshold at that time. Well, to support that loan book, you would have needed around $8 million in capital. And that $8 million, that's just the 100% times the 100 million times the 8% Tier 1 capital ratio target. And that $8 million could have included some of those hybrid debt equity securities that were disallowed after the financial crisis. So in reality, it might have been more like $6 or $7 million in what we now call common equity Tier 1 capital to support $100 million in commercial loans. So just $6 or $7 million in what we would now call CET1 capital to support $100 million in commercial loans. You see the multiplier effect there? Today, the equation is very, very different. The risk weight for loans to middle market companies might be 100% or even 150%, as I said, depending on the risk level and structure. And to maintain a comfortable margin over regulatory minimums, a bank like Key would probably be targeting a CET1 ratio of more like 11 or 12%, like Key did in 2025. So to support $100 million of loans to middle market companies, representing risk-weighted assets of maybe 100 or even 125 million, because some of those loans carry above 100% risk weights. Well, a modern bank might need to hold more like 11 to even $15 million in CET1 capital, close to twice what was needed or even more pre-financial crisis. Now think about that to support that $100 million loan book. Now think about that from a return position, from the bank's perspective. Tying up $6 or $7 million in capital to generate interest on a $100 million loan portfolio, well, that's a heck of a lot more profitable than tying up 12 or 15 million in capital to generate interest on the same loan book today. In contrast, for the largest US banks using what's known as the Advanced Internal Ratings-Based Model, AIRB, regulators love acronyms, the risk weight for loans to a pool of larger investment grade rated companies that are publicly traded, well, that might be 50% or even lower. So supporting a $100 million loan book to those companies might require just $5 to $7 million in capital today. That's a lot more efficient from a capital perspective than lending to smaller middle market companies, which carry a higher risk weight. Further, as I said, US Treasuries carry a risk weight of 0%. So holding more Treasuries doesn't penalize the bank from a capital perspective. Here's a result of that. This chart shows U.S. Treasury and agency securities held by all U.S. commercial banks between 1947 and June of 2026, the last month for which we have data. As you can see, from December 2008 to the all-time peak in March of 2022, banks' holdings of U.S. Treasuries soared by more than $3.44 trillion, from a little over $1.25 trillion to almost $4.7 trillion. Now that's annualized growth of 10.5% in banks' holdings of U.S. Treasuries, almost triple the 3.65% annualized pace of the 15 years leading up to December 2008, the financial crisis. And look at this chart. As you can see, even long after the U.S. economy recovered from the great financial crisis, growth in bank loans, that's the blue line here, was tepid, particularly when compared to the parabolic increase in banks' holdings of U.S. Treasury and agency securities. That's the red line. If you assumed commercial banks were still primarily in the business of funding private enterprise, kind of a logical assumption, I would say, the numbers, they tell a very different story. Post-2008 regulations effectively re-engineered the U.S. banking system, turning the financing of government debt into the path of least regulatory resistance. However, just because global governments devise a new regulatory framework for banks that led to a decline in lending, commercial lending, that doesn't change a simple fact. Small and mid-sized companies still want and need capital to grow and expand. And while higher capital requirements made lending less profitable for the banks, the business of lending out money in exchange for interest, well, that's been around since at least the time of ancient Mesopotamia, some 4,000 years ago. Now we know that because one of the very first things humans did when they could write and record stuff on ancient tablets was to record the interest that merchants charged on loans of things like grain and silver. Even better, the government's new regulations not only push banks out of the lending business, they push private investors into the lending business. After all, yields on Treasury securities and high-quality investment-grade bonds collapsed after the financial crisis, as the Federal Reserve sought to drive down interest rates via quantitative easing. And ironically, the regulatory infrastructure I just outlined forcing banks to buy government bonds regardless of yields, or at least strongly encouraging it with a risk-weighted asset of zero. So in effect, you have a group of middle market companies, right, willing to pay higher rates to borrow money, higher rates than a larger company would pay. And you have a group of savers and investors, institutional and private, looking to generate higher yields on their cash. Enter private credit. Historically, alternative asset managers and private equity firms like Blackstone, KKR, or Ares, they would put together a private credit fund with investment money from large institutional firms like pension funds, insurance companies, sovereign wealth funds, and university endowments, just some examples. Crucially, these were closed-end funds with a fixed term. They were designed to have a life cycle of 7 to 10 years, sometimes with optional 1 or 2 year extensions. This investment capital was then loaned out to middle market companies, and there was zero interim liquidity. That means that investors' funds were locked up for the term of the deal. Cash only flowed back out to the partners in the fund, those institutional investors I mentioned, as borrowers of the money made interest and principal repayments over time. Now, such funds also usually deployed some portfolio level leverage, debt, amounting to 30 to 50% of the total fund's assets. Now, that was profitable because the funds themselves, unlike the borrowers in the fund, right, they could borrow money from banks using their loan portfolios as collateral at far lower rates than the rates they charge to middle market borrowers. These funds were and are attractive because the institutional buyers could earn far higher returns than what's available in the public bond markets. More recently, we've also seen the emergence of what are known as evergreen or more commonly perpetual private credit funds. And these are often marketed to high net worth individual investors through wealth management channels. These feature a lower required minimum investment, right? And offer some liquidity. And that means that typically investors as a group in the fund are allowed to withdraw an aggregate of up to 5% of the fund's net asset value every quarter. Now the reason for that limit, which is often known as a gate, is that the underlying assets are illiquid. You can't readily sell a portfolio of individual loans to small and mid-sized companies quickly to meet investor withdrawal requests. So the funds limit how much money investors can withdraw each quarter. Finally, there are also the publicly traded business development companies, the BDCs. And those do trade on the major stock exchanges like NYSE and NASDAQ, just like any other stock. Examples include Ares Capital Corporation, trading under the symbol ARCC, and Blackstone Secured Lending Fund under the symbol BXSL. ARCC, that's sponsored by Ares Management Corporation, a multi-billion-dollar alternative asset manager that's also publicly traded. And BXSL, it's sponsored by, as the name implies, Blackstone, one of the largest private equity companies in the world. So when these BDCs go public via an initial public offering on the stock exchange, they raise permanent equity capital from selling shares to the public to invest in a diversified portfolio of private credit loans. They also typically raise debt capital. Now, the statutory maximum under the Investment Company Act allows a debt to equity ratio of 2 times, but most of these BDCs operate far more conservatively than that. More typically, debt to equity ratios are closer to 1 or 1.25 times. So that equity capital is permanent. The money they raise in that initial public offering, that's permanent to the lender. It has nothing to do with where the stock is trading on the secondary market, on the stock exchange. So management never faces redemption runs or forced asset sales. Even while individual investors, well, they can enjoy full liquidity to buy or sell shares with a BDC on the stock exchange throughout the trading day, just as for any other stock or ETF. In short, private credit loans are similar to bank loans overall, except that these are non-depository institutions. So they don't have to worry about a run on the bank, where depositors want to withdraw their money en masse. All of these private credit funds rely on some form of locked-in or permanent capital, whether it's equity capital raised through an IPO, institutional capital locked into a 7 or 10-year term, or investor money, high net worth investor money, with gates to limit withdrawal requests each quarter. Accordingly, they're not subject to all the Basel III rules and the CET1 ratios that squeeze the commercial banks out of this business after the financial crisis of 2007 to 2009. Also, like traditional commercial loans at a bank, private credit loans typically carry floating interest rates. So they're priced against a benchmark. So for example, the most common benchmark in the US these days is what's known as the Secured Overnight Financing Rate, SOFR. And that's closely tied to the Fed funds rate. A loan to one of these middle market companies might carry an interest rate of SOFR plus 500 basis points. That's a fancy way of saying 5%. Or SOFR plus 600 basis points, 6%. Here's a chart showing SOFR and Fed funds over the past several years. Now the green line is the SOFR rate, while the red and blue lines are the upper and lower bounds of the Fed's target range for that Fed funds rate. The Fed funds rate, of course, is the key short-term interest rate benchmark set by the central bank in the US, the Fed. Apart from that period in late 2019 that I've labeled what has come to be known as repo madness, that's a topic I'll leave for another day. SOFR typically sits inside the Fed funds target range. So that's why you'll often hear or read people saying that bank stocks benefit from Fed rate hikes. The fundamental reason is that most commercial loans carry floating interest rates, and that's benchmarked to SOFR. So when the Fed hikes the interest rate charge on those loan balances automatically resets higher, generating more interest income. Of course, that's not always the case, right? If, for example, the Fed is hiking aggressively to control inflation, the situation back in 2022, for example, the market might worry about a potential recession that could impact borrowers' ability to service their debts, right? However, when the economy is in sound shape and the Fed is hiking, that's a net positive for lenders charging floating interest rates. And that's not just true of banks. As I've just outlined, private equity funds and private credit funds and the BDCs, well, they also charge floating rates and accordingly also benefit from Fed rate hikes. Now consider this. The SPDR Blackstone Senior Loan ETF, that's an exchange-traded fund or ETF trading under the symbol SRLN on the New York Stock Exchange. It's just using it as an example. This ETF holds a portfolio of bank loans. Specifically, these are known as broadly syndicated loans or BSLs. Now, under a BSL deal, a large bank like JP Morgan or Bank of America, well, they agree to lend money to a company at an agreed upon spread, a spread over SOFR or whatever benchmark they're using. Once agreed, the lead bank, the big bank, they chop up the loan into smaller pieces, which is a process known as syndication, and they sell off those pieces to institutional investors, including ETFs like SRLN or insurance companies or whoever's buying the loan, institutions. Typically, most of these BSL loans are made to larger companies that have formal credit ratings from the major agencies like S&P and Moody's. In SRLN's case, about 30% of the loans in the ETF are rated single B, and 25.8% are rated B-, with only about 7% of the loans not carrying credit ratings. Only about 7% of the loans in the ETF not carrying credit ratings. These loans are actively traded between institutions on the secondary market as well. So typically a BSL loan might carry a floating interest rate of 3% to 4.5% over SOFR. And right now SOFR is sitting right around that 3.7% range. Now consider Ares Capital, a large well-known BDC. That's the one I mentioned earlier, trading under the symbol ARCC. This company typically lends to far smaller companies that typically do not have credit ratings and don't have access to the BSL, the broadly syndicated loan market. Now, unlike private funds that report very little to the public, publicly traded BDCs like ARCC, they provide extensive transparency in their SEC filings. In every Form 10-K and 10-Q, Ares publishes a line-by-line schedule of investments detailing the exact contractual spread over SOFR for every single loan in the portfolio. Typically, that would be around SOFR plus 500 to 600 basis points, so higher spreads. ARCC and other BDCs also originate their own loans, negotiating directly with the borrower, unlike in the BSL market where there are likely to be hundreds of lenders once the loan is fully syndicated. Now the Van Eck BDC Income ETF, trading under the symbol BIZD, B-I-Z-D, B-I-Z-D if you prefer, they own a portfolio of individually publicly traded BDCs. And as I just outlined, the SRLN ETF, the senior loan ETF, they own a portfolio of these broadly syndicated loans. Now 2 points. First, one would expect that the macro drivers for both assets would be similar. For example, rising rates benefit both ETFs as they both own exposure to floating rate loans. Now a recession or credit crunch would also impact both by hurting borrowers' collective ability to service their debts. Second, in financial markets, the reward for taking on more risk is typically a higher potential return. And in this case, the pool of BDC borrowers looks riskier than the pool of BSL borrowers, the broadly syndicated loan borrowers, which are much larger companies. Accordingly, the BDC borrowers will tend to pay a higher spread over SOFR. The bottom line from these 2 points together is that I'd expect SRLN and BIZD to follow the same basic trends, with BIZD outperforming when the economy and credit markets are strong, while SRLN would be likely to outperform BIZD during periods of economic stress, given the higher average loan credit quality. Well, take a look. The basic framework I just outlined, it checks out. The chart shows the relative strength of BISD, that's the BDC ETF, to SRLN, the broadly syndicated loan ETF. Simply put, when the blue line goes up, that means BISD is outperforming SRLN on a total return basis, meaning that we're looking at the performance of both ETFs, including capital gains and distributions, basically the ETF equivalent of dividends. I set this relative strength line to a level of 1.0 at the beginning of my chart in April 2013. Now I've put some labels here to show key events, but basically you can see that in normal credit market and economic environments, BISD tends to outperform, while it notably underperforms in times of stress or mid-recession fears. Stress periods would include the COVID lockdown collapse and recession in the spring of 2020, the 2022 recession and inflation scare. We didn't actually have a recession, but an inflation and recession scare. And of course, the spring 2025 tariff panic. In contrast, look at that green arrow there from late 2022 to late 2024 or into early 2025. This was a period when the Fed was still pushing up short-term interest rates, or at a minimum holding rates at the highest levels in decades. That kept SOFR at a healthy level and accordingly was a boon for floating rate loans. Also, recession fears faded starting in late 2022 and early 2023, so BISD generally outperformed. Now look at the very hard right edge of my chart. While BISD initially outperformed SRLN coming off the tariff panic lows, that rally stalled out in late July of last year, 2025, and BISD has dramatically underperformed SRLN over the past year. Let's look at a close-up of this period. The red line here shows the total return from SRLN since the end of June 2025, and the blue line represents BIZD on the same basis. Now, as you can see, SRLN has been a solid and steady performer, especially since March of this year, while BISD has been volatile and generally weak until very recently at least. Over this entire period, SRLN has outperformed BISD by 11.2 percentage points, and that's despite this. This chart shows the yield on 2-year US Treasury bonds less the yield on the 3-month Treasury bill. Generally, when this spread is positive, when 2-year yields are higher than T-bill yields, what that means is that the market is expecting the Fed to hike rates over the next 2 years relative to the current level. Average interest rates are expected to be higher over the next 2 years than the current level. In contrast, a negative spread indicates expectations for cuts. Now, as you can see, last summer the market was looking for the Fed to cut rates, and the Fed did deliver some cuts late last year. The spread remained negative into early 2026 though, even after those Fed rate cuts. Market expecting more cuts in 2026. However, this summer, this spread is up in the positive 0.35 to 0.50 range, indicating that the market is looking for rates over the next 2 years to be higher than the current level. And higher rates is, as I've outlined, a tailwind for both BISD and SRLN. However, as I just showed you, SRLN has benefited and BISD has not. BISD has been dragged down by two main issues. One, BDCs tend to make significant loans to companies in the software business. And there's a narrative out there that artificial intelligence, AI, will disrupt the software industry. Two, concerns about the broader private credit market, particularly non-traded perpetual private credit funds marketed to qualified individuals, high net worth investors, and the private equity firms like Blackstone, KKR, and Blue Owl that manage these funds. Now, here's a proxy for the software apocalypse narrative. This chart shows the relative strength of the iShares Expanded Tech Software Sector ETF, which tracks a portfolio of over 100 software stocks. I think it's about 106 right now, traded in the US. Now, I'm not showing you in absolute terms, I'm showing it relative to the S&P 500, including all dividends. Now, as you can see, software stocks began to weaken dramatically relative to the broader market in September 2025, which I've labeled. And that corresponds to the start of the period of most significant underperformance for BISD relative to SRLN. So that lines up. The good news now is that this trend has started to reverse higher again, as you can see. Software stocks bottomed relative to the S&P 500 back in early April, and even as the S&P 500 has generally performed well this summer, software stocks have been beating the market, performing even better. In my view, this reflects a few trends. One idea making the rounds earlier this year was that companies would be able to create their own code, their own software in-house, using AI tools rather than buying from a third-party software provider. However, in late April of this year, we had some reports that Uber, the rideshare company, they'd actually burned through their entire annual 2026 AI token budget in a matter of just 4 months. And this is not an uncommon experience. Now, AI tokens, they're a unit of text that an AI model reads and generates. So 1,000 tokens is roughly equivalent to 750 words of text in English. And enterprise AI uses a lot of tokens, right? So coding using AI rather than buying from a third-party software company started to look a lot less economic in reality than it might have seemed on paper because token costs went up. Second, not all software companies are truly vulnerable to AI disruption. Mission-critical systems of record like enterprise resource planning systems, proprietary healthcare billing systems, core compliance databases, vertical-specific operational software, these systems hold proprietary customer data. They involve massive switching costs, and they're too deeply integrated for an enterprise to swap out on a whim. Second, look at this. This chart shows the relative strength of two private equity firms, Blackstone, red line, KKR, that's the green line, as well as the alternative investment manager Ares, which is behind the ARCC BDC I talked about earlier. As you can see, all three of these stocks hit a performance wall at the end of July 2025, and all three of these names are key sponsors of BDCs in the BizD portfolio. Now this summer, all three stocks appear to be bottoming out. That brings us to the other major overhang dogging the alternative asset managers and the publicly traded BDCs, the panic over investor redemptions in semi-liquid, non-traded perpetual private credit funds earlier this year. Now, as wealth management channels saw elevated redemption requests, mainstream headlines began confusing a liquidity management issue with a credit solvency crisis. When high net worth investors tap the 5% quarterly exit gates to rebalance their portfolios or lock in gains, it does not mean the underlying middle market borrowers are defaulting on their loans. Publicly traded BDCs like ARCC and BXSL, they hold permanent equity capital. They cannot be forced to sell assets at a loss to meet a redemption queue. Now, with those retail redemption bottlenecks stabilizing, fewer investors wanting to take out money, and default rates across the high-quality sponsor-backed portfolios remaining well within historical norms, that synthetic drag and all the negative headlines about withdrawal requests, well, it's clearing out. When you pair an easing liquidity narrative with software credit holding the line, the steep discount applied to BizD relative to syndicated loans, SRLN, begins to look like a classic sentiment overshoot, a panic. In short, the panic created the spread, and as the panic recedes, that double-digit cash yield is finally getting rewarded again. So thanks for listening. I hope you enjoyed this week's Sunday Deep Dive. We covered a lot of ground this week, and it's a complex topic, so I do hope that this video helps shed some light on private credit and changes in banking regulations that led to all this growth. If you enjoyed this week's video, please drop me a like or a comment. And you can subscribe for free to make sure you receive this weekly video and my other posts and updates as soon as they're released. Now, last week with my Sunday Deep Dive video, I posted a link to download my reports on the weekly Commitment of Traders report from CFTC. Now, I see a lot of you downloaded the report, and some have asked me to provide an updated report reflecting the latest data, which was released on Friday, August 14th. So once again this week is a free or paid reader on Substack. If you're watching this on YouTube, I'll put the link down below in the first comment. You can also download the latest Commitment of Traders data using the link below this video. If you want to know more about how I interpret this data, for example, if you missed last week's video, I'll put a link to last week's video down below as well. If you'd like to give the paid tier of Free Market Speculator, including our popular Energy Bulletin Top 10 model portfolio, if you'd like to give it a try, I'm still offering 14-day free trials via the link below. And for the sister publication Smart Bonds, where I cover BDC and senior loan ETFs, I am offering 30-day free trials. I'll put the link to that offer below as well. And please note that I recently published my quarterly report for Smart Bonds there, and I will have an updated portfolio table for all 3 model portfolios in that service out early next week. Thanks again. I'll see you next week for another episode of my Sunday Deep Dive.